Everyone. I'm Satej and I'll be giving you a basic overview of the order to cash process. This overview would help you understand the overall revenue management process for manufacturing, consumer and industrial goods companies. This will not be relevant as far as any infrastructure or service related companies are concerned. This tutorial would be helpful for beginners in the area of process consulting and internal audit. We'll look at the end-to-end revenue process for the respective industries that I've mentioned and also try and identify who would be the key stakeholders for a review of order to cash. A quick reminder, always ask 6 questions: who, what, when, where, why, how, whenever you're doing any walkthrough so that you get adequate answers and correct answers for whatever questions you're asking your stakeholders. So let us look at the order to cash process. So as the name suggests, order to cash is looking at all the activities that are conducted within a company right from the time the company receives an order from its customer till the time cash is received from the customer against the order. So when I say cash, it means money in any form. So let us look at what all activities are carried out within the O2C process. The first piece is the order management. So imagine any manufacturing company or any pharma or any FMCG company to which this particular process flow would be relevant. These companies would either dispatch their goods from their warehouses or from their factories directly. Now, whenever an order would be received, this would be taken by the relevant key account manager or the sales personnel who is on field or interacting with the customers. So the first stage is order management. So the order that is given by any of the company's customers would get recorded in my database. In normal ERPs like SAP, there would be a sales order which would get created, and the sales order would give the details of the customer, the order received, the quantity of goods that have been ordered by the customer, and the rate at which I have agreed to sell the goods to the customer. So order management would be the first piece of my order to cash process. Of course, the rate at which I am going to sell my customer depends on the industry. For example, a simple FMCG company would have its MRPs and its retailer prices and distributor prices pre-decided. Or in case of goods like steel, the factory prices would be published at the start of the month. Field, in case of any other goods, the sales teams would negotiate a particular rate, and this is true in terms of any bulk chemicals or drugs, where the rate would be negotiated by the customer. The customer would then issue a purchase order to the sales staff. The sales staff would then enter the corresponding sales order in the company's ERP. So that is how the order received from our customer would get recorded in our ERP. Now, once the order has been recorded, this is assuming that the customer already exists. But if the customer does not exist, then there has to be a customer onboarding process. Why that is important is because any customer to whom we are going to be selling any of our goods, we need to be sure that our sales are secured. It means that we would be receiving collections against the sales that I'm making. It should not happen that I make sales to the customer and the customer never pays me back. To prevent that from happening, companies follow a very strict KYC or know your customer process, which is basically a customer onboarding process. This would be followed each time a new customer is onboarded and would generally happen before the order management process. As part of this, certain set of mandatory documents might be required to be submitted by the customer, and the sales team would also be required to do a basic check of the credit worthiness of this customer. In certain mature organizations, you would have credit management teams who do these assessments. Once the order is received, the credit check of this particular order would happen, which means that there would be a check against the credit limit that has been assigned to this particular customer code. Now, each customer would be assigned a credit limit on the basis of certain criteria. Most of the companies would look at the past history of such customers. They would look at what is the quarterly offtake, what are my quarterly sales, whether the customer is paying in time or not, what is it that I am listening about the customer from the market, is the credit position of the customer sound enough, are there any red flags in any of my previous dealings, or have I faced any challenges in collection from this customer in the past? On this basis, there would be a detailed credit management that would be performed, in which a credit limit would be assigned to each of my customers. Some companies also end up classifying their customers into ABC categories. A being the best customers or the most credit-worthy customers, and C being the least credit-worthy customers. The credit limit that they would extend to their customers would depend on the customer grading criteria. Now, once the credit limit check is passed, that I have received an order and I have adequate credit limit for that particular customer, the order would go in for a fulfillment. It would mean that the order would be then shared with the dispatch team at the factory or at the warehouse or at the C&F agent, from where this order would be shipped to the shipping address as given by our customer. Along with shipping, the invoice also would get generated. Now, typically in the Indian context, and given the GST requirements, each consignment would be supported with the corresponding invoice. In certain cases, the e-way bill would also be required. This invoice would be generated either at the plant or at the warehouse or at the point of dispatch, as the case may be. The invoice typically should be generated from the system, and most of the companies these days do not encourage manual invoicing, especially the large corporates. These invoices would then get generated in SAP against the sales order. The typical control here is that the invoicing cannot exceed the total quantity of sales order which has been approved in line with the credit management. So my invoice would then get generated and shared with the customer. Once the invoice is generated in the system, automatically it would start showing as a creditor, and then either my sales teams or my follow-up teams would then interact with the client and get this money collected over the period of credit term that I have authorized. Now, the collection could be in the form of debt, or it could be in the form of checks that would get collected and deposited in the company's bank account, post which the collection entry would get posted in the system, and the invoice would get knocked off against the payment which has been received. If the customer has paid in part, of course, there would be additional follow-up, and it would ensure that 100% of the amount is collected. Now, here, as part of reporting, you would report a lot of things. For example, if you've not collected from your customer against any invoices, the companies would follow standard reserve for doubtful debt policies, in which they would probably provide for invoices which have not been paid in excess of 180 days or 360 days, as the case may be. In certain cases, there might be write-offs wherein the customers have not paid for a long time. Write-off decisions would also be taken by the accounts team, and they would generally require approvals at the highest level. So, to summarize, my order to cash process started with customer onboarding. Then we got the order from the customer. The order from the customer was then checked against the credit limits assigned to that particular account. Once the credit limit was checked, the order gets fulfilled. There would be picking and packing and shipping from my warehouse. When it gets shipped, an invoice would get generated. Each consignment would be supported with an invoice. The invoice would get posted to the respective customer ledger. There would be a collection entry that would happen against each open invoice. If the invoice is open, there would be a collection follow-up. Or if the customer is not paying for a period exceeding 180 days or 365 days, there would be a reserve for doubtful debt or potentially a write-off. So these are the activities that typically would get covered as part of the O2C process. Now, mind you, as I said, this is a typical process that would be followed at manufacturing companies, consumer companies, industrial goods like chemicals, pharma. Most of these companies would follow this particular process. There would be specific variations. For example, if you are talking about FMCG companies or pharma companies, the sales would be done from CNF agents who are holding stock of the company. And the first point of invoicing would be the CNF agent. So the point of sales is actually the CNF agent. In case of any industrial chemicals, the point of sale would happen to be the factory. In case of any other companies, like for example steel, you would have depots from where the sales would happen. So regardless of the point of sale, the process would overall remain the same. The elements of customer onboarding, order management, credit management, order fulfillment, invoicing, accounts receivable, collection would remain the same. So you will really need to understand what industry your client is in and accordingly utilize some of the nuances that we have just discussed. So looking at the key stakeholders for any O2C audit or any O2C process review, you would end up interacting with the following 6 sets of people. First one would be the master data team. This team would essentially be responsible for creation of a customer code, because we need to understand that without creation of a customer code, either your order would get created. If your order is not there, your invoice would not get created. If you've not created an invoice, you would not collect it. So a code creation typically in any ERP environment is the first point of entry of your customer or your vendor or your material. So that is why this happens to be one of the critical starting points, and we need to check that. So master data team for code creation. The next one would be your sales teams. Now the sales teams would be the ones who are interacting with customers. They are the front end staff for the organization. They are bringing in cash for the company. They are the ones who would be negotiating for the price. They are the ones who would be finalizing the quantity of sales that need to happen. And they are the ones who are typically under tremendous pressure to get the sales targets for the company. The idea for us to interact with them and understand how they are finalizing the orders, what is the kind of paperwork that they are maintaining, how are they finalizing the rates, how are they deciding the rates, are these rates decided or approved by the company or by the zonal teams or individually during negotiations. From a price and sales order finalization perspective, it is important for us to interact with the sales teams. The credit management team would be another key set of people that we would need to interact with. These are the ones who are assigning credit limit whenever a new customer gets created, and these are the ones who would on an ongoing basis monitor the credit exposure of the company. So these are the ones who look at reducing or exceeding the credit limits, and they are the ones who would actually authorize any sales orders that are exceeding the assigned credit limits. So if the credit limit needs to be brought down to say 0 rupees because of certain poor experiences with a particular customer, the credit management team is authorized to do that. If they've taken up the credit limit from say 10 lakhs to 1 crore, they would need to have a very solid reason for such a credit exposure being taken. Hence, it is very important for us to understand the credit management philosophy of the entity. Companies definitely have credit policies. We should be going through those. And it is a good idea for us to interact with the credit management team because these are the ones who would be managing the credit limits as well as the credit period. So the credit cycle and the cash flow cycle would generally be in the hands of the credit management team. And that is the reason why we should interact with them in detail. The next team is the dispatch team or the warehouse team, and these are the guys who are actually generating the invoice. It should not so happen that I have actually dispatched 100 quantities, but I have invoiced only 80 quantities. That would mean that I am actually incurring a revenue loss. So this happens to be a very key control uh, because everything that gets dispatched should get invoiced, and the team that is doing that at the warehouse or at the dispatch zone is the one who is primarily responsible for it. So a walkthrough with this team is also essential because these are the ones who would tell you how they generate an invoice, whether the invoices are created on a timely basis, and whether whatever gets dispatched gets invoiced. The next team is the debtors collection team. These are the guys who are continuously following up with either the sales teams or directly with the customers trying to get the money that they owe to you. They would perform certain analysis at their end. These are the guys who would keep on monitoring the accounts receivable position of the company and performing an aging analysis of receivables. If anything goes in a bucket that the company is not very comfortable with, then these are the ones who would chase the sales teams and the customers so that the collections are made in time. These guys typically have targets given to them as well as far as recoveries are concerned. The last team is the accounts team. These are the folks who are responsible for the overall revenue management. uh, they would be responsible for the revenue recognition. Uh, Please keep yourselves updated with the revenue recognition standards as required for the respective industry. It would be a good idea for you to understand as to how the revenue recognition cutoff for that respective industry or company would work. Do they have a revenue recognition policy? How are they actually maintaining cutoffs? This is a very important piece of any process review that you would end up conducting. So please be mindful of that. Also, what would be important is to check any kind of credit notes or debit notes that would be posted to customer ledgers. If a customer is sending back some goods to you, you would need to issue credit note to them. Now, this typically also is a gray area because it would so happen that you might end up selling 100 and the customer returns the whole consignment of 100 to you, and you would be required to post a credit note of 100. If I end up posting a wrong credit note or a credit note for amount in excess of what has been returned to me, I'm running a revenue loss. Hence, this again becomes a very, very critical component of my over O2C process. Of course, from an overall accounting perspective, the provisions and write-offs would also need to be looked into. And as part of your walkthrough, you should also cover the policies and processes around provisioning and write-offs. Most companies would have a very strict view on write-offs, and these write-offs would happen post the approval at the highest level at the MD or the CFO level. So this is a typical O2C workflow. I hope you have a broad level understanding as to how the O2C process works. Of course, as I mentioned, and a disclaimer again, what we've discussed is a generic workflow for manufacturing companies, for industrial goods, for FMCG, pharma. of course, for the sector that you are currently working on, there might be a different O2C flow. So please check with your seniors with respect to that. That was my overview on the O2C process. Thank you so much.